Speakers on today's call are Mr. Jagan Reddy Nellore, Vice Chairman of Rain Industries Limited, Mr. Gerard Sweeney, President of Rain Carbon Inc., and Mr. T. Srinivasa Rao, Chief Financial Officer of Rain Industries Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. During the conference call, the management will be referencing and discussing a slideshow presentation which is available for viewing on our website at www.rain-industries.com in the Investor Relations section. It is recommended viewing this presentation while listening to the management's discussion. Before we begin, management would like to mention that some of the statements made in today's discussion may be forward-looking in nature that could be affected by certain risks and uncertainties. The company's actual results could differ materially from such forward-looking statements. Now, if you could turn to slide 3, I would request Mr. Jagan Reddy to provide an update on key developments within the Rain Group. Thank you, and over to you, sir.
Thank you, operator. Good evening to everyone. I would imagine that, like me, many of you are relieved that 2020 is over and looking forward to getting back to life as it was prior to the coronavirus pandemic. Despite 2020 being a year we all want to forget, it was the safest in the company's history, with 13 of our sites completing the year without a recordable incident. In fact, across our organization, we have operated 252 days without a recordable incident. Other than a few weeks nationwide lockdown in India, no other production facilities globally were shut down due to COVID. We overcame significant damage from the strongest hurricane to hit the Louisiana area in the last 150 years and continue to operate our plants safely with only essential operators on site. We also fully executed our plan to cease operations at our Newton facility and optimize production at our Duisburg site, essentially producing the majority of the same products at one site instead of two. This improved efficiency is one of the reasons we were able to maintain EBITDA in a year that had reduced sales volume and many headwinds. Turning to slide 4 of the presentation, EBITDA of Indian rupees 4.8 billion in the fourth quarter was down 7% from Indian rupees 5.17 billion during the previous quarter. This decrease reflects the seasonality of some of our products sold in Europe and North America from our carbon and advanced materials segment, which are not in high demand in cold weather. Revenues for the fourth quarter was Indian rupees 26.4 billion compared with Indian rupees 25.66 billion in the third quarter. The sequential improvement in light of reduced earnings occurred primarily due to improved volumes and pricing and appreciation of euro against Indian rupees. This was the second consecutive quarter that we have seen an increase in revenues, giving us hope the global economy is returning to normalcy, albeit slowly. On the carbon side of our business, volumes were up about 4% and revenues increased about 7% from the third quarter. This was despite the lingering impact of damage caused by Hurricane Laura on our Lake Charles facility. Although we were able to restart both calcination kilns and electric generation plant, we lost about 1 month of energy income during the current quarter and were not able to produce CPC to capacity due to bottlenecks and other constraints caused by the widespread damage to the plant, resulting in under-absorption of costs. Our calcination business was also challenged by a continued worsening of global green petroleum coke supply. As we have seen throughout the pandemic, green petroleum coke prices continue to rise due to reduced refining of transportation fuels, which has negatively impacted refinery run rates and green petroleum coke production. On a positive note, bullish demand for aluminum and the anodes required for smelting has resulted in higher CPC prices, helping to offset the green petroleum cost increases, providing an optimistic view for the coming quarters. During the fourth quarter, we began to prepare to suspend calcination activities at our Robinson, Illinois facility. A range of issues have impacted demand traditionally served from the facility, led by access to cost-effective raw materials. During the current year budgeting process, amid raw material shortages, it became clear that it would be more economical to suspend operations temporarily until the supply-demand situation improves, especially from a green petroleum perspective. We will service the Robinson plant sales volume from our Gulf Coast calciners, and in the coming months will continue to evaluate the market for signs of improvement so we can resume calcination at Robinson. On the distillation side of our carbon business, pitch volumes were lower, largely due to the closure of an aluminum smelter and curtailments at an anode producer. On the margin side, we saw price pressure on traditional coal tar supplies as industries look for alternatives for raw materials typically sourced from oil refineries and add demand pressure. In terms of other carbon products, creosote volumes were down slightly due to the seasonality, while volumes of carbon black oil were up about 9% as we sold inventory that had built up from second quarter. Finally, crude naphthalene volumes grew by about 11% thanks to the increased demand by the construction industry. Turning to advanced materials, fourth quarter saw lower volumes, which resulted in an 8% decrease in revenue compared with the third quarter. This was primarily due to a seasonal reduction in engineered product sales, in particular our sealer-based products, which falls off in the winter months. Our petrol sales volume remains strong, which reflects the transition to electrical vehicles in many parts of the world. And sales of our carburetor specialty binder increased by more than 9% during the quarter as demand from Asian countries rebounded as the impact of COVID began to subside. Elsewhere, carbon resin sales were flat with third quarter, and sales of our petrol resins increased during fourth quarter. Petrochemical intermediate volumes were up substantially, but pricing changed in line with the benzene quotations. Finally, sales of naphthalene derivatives during the fourth quarter were stronger due to increased demand for phthalic anhydride, PNS products, and refined naphthalene by the construction industry. Regarding naphthalene derivatives, we closed the fourth quarter with the sale of our polymer business, which primarily consisted of our production facility in Candiac, Canada. This downstream business fell outside of our core businesses and had always been run as a standalone enterprise with few synergies other than utilizing naphtha oil produced at our distillation facilities. In our cement business, there was an increase in volumes and revenue by approximately 11% and 2%, respectively, compared with third quarter. The sales volumes have improved across all regions where we operate. Segment EBITDA decreased by Indian rupees 252 million compared to third quarter, mainly due to lower realization. With good monsoons in South India, the rural economy should provide strong impetus to increase construction activity and thereby cement demand over the next several quarters. With this business update, I will now turn over the call to Jerry Sweeney to take you through the industry and other business updates on slide 5. Jerry?
Thank you, Jagan, and good evening, everyone. It's a pleasure to speak with you all again. Turning to slide 5, aluminum demand is now higher than pre-pandemic levels, and with the LME prices more than $2,100 a ton, are the highest since late 2018. Also, increased demand is driving pricing as there appears to be a global shortage of scrap and primary aluminum. Amid growing demand and rising prices, an additional 4.7 million tons of smelting capacity, 3 million of which will be in China, is expected to come online during 2021 in the form of new plants and restarts of previously idled facilities. At the same time, the decision by the new U.S. administration to continue aluminum tariffs instituted by the outgoing administration and potentially reinstate others that had been lifted should help to protect U.S. smelters from Chinese imports. These developments bode well for our carbon segment. Increased Chinese aluminum production should result in a decrease of CPC exports out of that country, creating more opportunity for us to serve the rest of the global market. Similarly, there should be less Chinese coal tar pitch exported to places like the Middle East and South Africa, which should be beneficial to us as well. In terms of aluminum pricing, we are now seeing deals in the market for low carbon aluminum. However, in Q4 of 2020, we began seeing companies pay a slight premium for low carbon aluminum. As smelters and anode producers look to capitalize on this emerging sustainability trend, we believe that our engineered anhydrous carbon pellets, or ACP, could be a differentiator in helping aluminum producers reduce their emissions and energy consumption, contributing to the marketability of their low carbon aluminum. Continuing on ACP, let us turn to slide 6, our major projects. Construction has resumed at our ACP production facility in the United States and will commence in Q2 2021 in India after being halted due to the risk of COVID exposure amongst employees and contractors. Beyond its emissions and energy advantages, ACP will give us the unique ability to maximize our GPC feedstock as the rapid global transition to electric vehicles reduces demand for transportation fuels and the resulting availability of feedstock for our calciners. In a world where petcoke supplies are becoming increasingly tight, the ability to achieve enhanced green petroleum coke utilization rates when we calcine ACP by reducing the consumption loss during calcination could be a differentiator when it comes to production economics, raw material availability, and sustainability. Construction on our new vertical shaft calciner in India is largely completed, and we could begin production within weeks of receiving a satisfactory ruling on the importation of raw material feedstock for the facility. The ability to import the needed raw materials for the shaft calciner is critical because of the shortage of available domestic GPC. Across India, supplies have become even tighter as cokers are producing less petcoke during the pandemic, and competition for domestic GPC versus higher cost imports has intensified. Once commissioned, each of these projects and their carbon extending and emissions reducing technologies will strengthen our position as a leading sustainable global producer of essential carbon-based materials. Finally, an update on our new hydrogenated hydrocarbon resins plant in Germany. After spending much of the second half of the year working with customers on product testing and validation, we reached our first sales milestone for our advanced water white resins in the fourth quarter. The qualification process was understandably impacted by COVID, since the pandemic has reduced customers' willingness to conduct testing and introduce new products while working with skeleton crews. Additionally, we continue to work to optimize operations of this plant. It is a highly sophisticated unit, introducing new technology and capabilities to the industry. Looking forward, we will continue to ramp up production and anticipate continually increasing sales volumes in 2021. Before I turn the call over to Srinivas, I would like to congratulate our employees for completing 2020 with a total recordable injury rate of less than 0.14, making it the third year in a row that we have established a new company best for annual safety performance. In any year, that would be a remarkable achievement, but the fact that we finished 2020 with so few recordable injuries is beyond remarkable when you consider that we achieved this while implementing radically new health and safety practices due to COVID, as well as starting up our new advanced resins facility, dealing with the significant damage from a hurricane and completing one of the most complex maintenance turnarounds that we have ever attempted. With that, I'll now turn the call over to Srinivas, who will take you through the consolidated financial performance of Rain. Srinivas, over to you.
Thank you, Jerry, and good evening, everyone. It is a pleasure to speak with you today. In the fourth quarter of 2020, Rain achieved consolidated net revenue of 26.4 billion rupees compared to 28.3 billion rupees in the fourth quarter of 2019, a decrease of 1.9 billion or about 6.7% decrease. This resulted from a decrease in revenue of 2.34 billion or 12.3% decline from our carbon business segment and 0.25 billion or 3.7% decrease from our advanced material business, offset by an increase of 0.7 billion or 31.9% increase from our cement business segment. Rain's consolidated adjusted EBITDA increased by 269 million compared to the prior year. This resulted from an increase in the advanced materials segment by 367 million and an increase in the cement segment by 389 million, offset by a decrease in the carbon segment by about 487 million. Now turning to the next slide on carbon segment performance. Revenue from our carbon segment was 16.71 billion rupees for the quarter ended December 31st, 2020, compared to 19.06 billion for the same period last year. During the quarter, the sales volume decreased by 4.2%, primarily driven by lost CPC sales due to Hurricane Lara and reduced demand due to smelter closures. The average blended realization decreased by 8.5%, which was offset to some extent by appreciation of US dollar and euro against the Indian rupee by 3.6% and 11.5% respectively. Overall, due to the aforesaid reasons, revenue from carbon segment decreased by 12.3% during Q4 of CY 2020 as compared to Q4 of CY 2019. Adjusted EBITDA of the carbon segment decreased by 487 million due to decline in volumes, majorly on account of Hurricane Lara. Turning to next slide on the performance of advanced materials. Revenue from our advanced materials segment was 6.57 billion rupees for the quarter ended December 31st, 2020, as compared to 6.82 billion for the same quarter in 2019. During the quarter, there was a 7.6% increase in volumes driven by improved demand from Asian markets after recovery from COVID-19, improved demand from construction industries coupled with higher throughput based on improved raw material availability. During fourth quarter of CY 2020, the average blended realization decreased by 10.5%, driven by changes in customer mix and a decline in oil-related prices, which was offset to some extent by appreciation of the euro against Indian rupee by 11.5%. Due to the aforesaid reasons, revenue from the advanced materials segment decreased by 3.7% during Q4 CY 2020 as compared to Q4 CY 2019. Adjusted EBITDA for the advanced materials segment increased by 367 million rupees due to higher realization in engineered products and increase in volumes in naphthalene derivatives compared to Q4 of 2019, coupled with the appreciation of euro against Indian rupee. Moving on to the next slide on cement business. During the fourth quarter of CY 2020, cement revenue increased by 31.9% compared to Q4 of CY 2019 due to an increase in realizations by 21.2% along with an increase in volume by 8.8% as compared to last year. Cement EBITDA also increased by 389 million due to an increase in realizations coupled with lower costs. Moving to the next slide on debt. We ended the quarter with approximately $1,212 million of total debt, including approximately $77 million of working capital loans Net debt was $932 million and based on LTM EBITDA of $269 million, we ended the quarter with a net debt to EBITDA ratio of 3.5x. We are comfortable at this level as our average borrowing cost stood at 5% and we expect it to remain stable since the floating rate portion of our long-term debt is tied to the Euribor, which is still negative. Referring to our previous discussions, cash outflow on capital expenditure and plant turnaround costs for the year ended 2020 totaled $146 million, which was more than expected because we resumed construction activity during the quarter on our ACP project and incurred expenditure related to Hurricane Laura. Regarding liquidity, we ended the quarter with $280 million of cash on hand and $130 million of undrawn revolver credit facilities. The cash balance increased significantly due to proceeds from the sale of our polymers business. While this positions us very comfortably, we do not intend to maintain this position. Given that the transaction closed on 31st of December, we are still in the process of evaluating all options available to us to deploy the proceeds efficiently. The primary goal is to reduce debt and reduce interest expense for the group. With that, I will now turn the call over to the operator for Q&A session. Operator.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask questions, please press star and 1. The first question is from the line of Viraj Mehta from Equirus Securities. Please go ahead.
Yeah, hello sir, and congratulations for the numbers. So sir, if we were to normalize for the Hurricane Laura, what kind of volume growth we would have seen in the carbon segment?
Kerry?
On account of Hurricane Laura, we lost about 34,000 tons of CPC volume.
Yeah, that was the impact.
Okay. And so the exit run rate that you mentioned about the CPC business, is it showing traction back to or higher than pre-COVID levels than September quarter as well?
Yes.
Okay. So second thing, we essentially sold the business to repay debt is what we mentioned in our press release as well. But as we can see in the presentation today, our net debt has also gone up and our net cash has also gone up. I mean, on net debt level, it looks okay, but we are still not repaying debt. When does that start happening?
We just explained to you, the sale happened on December 31st. So obviously, any reduction of the debt will not appear in the December 31st balance sheet. And second thing is, you are able to see that there is an increase in the debt because the exchange rate, we have about 390 million euros of debt in Europe. And we are presenting the number in US dollars, and the FX rate between USD and euro has appreciated substantially against US dollar. Last year it was done at 1.12, and December 31st, 2020 it is 1.23. So $437 million of euro debt has got increased to $479 million. It's about $42 million increase is there only because of exchange rate.
Okay. And in terms of cash flows for this year, is it fair to assume that now that we don't have any major capex and normalization of margins is happening, all the cash flows will be utilized to reduce debt this year and onwards as well?
We can't say all cash, but our idea is to reduce the debt in the due course. At an appropriate time, we will be using the cash to reduce the debt.
But your understanding is correct that we want to reduce the debt and we would use all the surplus cash because we don't have major capex anymore. Thank you.
Thank you. Before we take the next question, we'd request participants that in order that the management is able to address questions from all participants in the conference, to please limit your questions to 2 per participant. Should you have a follow-up question, we request you to rejoin the queue. We take the next question from the line of Arvind Kothari from Nivesh I. Please go ahead.
Yes, sir. My question was on the upcycle that metals are experiencing. If you look at aluminium prices in China, also they are going up substantially. So, in that kind of a scenario, I wanted to understand that we are suspending one of our facility of Robinson's, and we had already suspended Grahancy calciner, a year back maybe. So how are we preparing ourselves for the upside in the requirement of CPC given what the prices today are basically maybe reflecting higher demand going forward?
Essentially, you heard from our comments, we do have spare capacity from the calcination perspective. So we have one plant that we've taken down mainly due to both market demand and raw material availability. As the demand strengthens, while we have very strong pricing in aluminum right now, we need more demand ultimately. So as that comes back, we will return to calcining at Robinson. And if we get a favorable ruling in the high courts in India, we can also start up our shaft calciner. So we're well positioned to feed continued demand growth from the aluminum sector going forward.
So on both, if you can give a more color, that how much time would it be, there that once you decide to start the Robinson facility, how much time does it take to restart the calciner? And also on the judgment of the Supreme Court, what is the current, you can say, position of the company in terms of when it expects, or what is the judgment status right now, if you could elaborate?
See, just to give you an idea, okay. Please go ahead, sir.
Yeah, no, as far as starting up a calciner, it's a matter of weeks. So it's not a very protracted process in order to bring a facility up. So that will not be a gating issue for us as far as meeting demand. As far as anticipated rulings of High Court in India, Jagan, why don't you go ahead and make comments about that?
Yeah, actually, we have approached the government, as a matter of fact, seeking some permission for some job work. And we are actually hoping that we should get a response in the next 2 to 3 or 4 weeks, actually. If we get a favorable response, that's fine. Otherwise, then we'll actually approach the Honorable Supreme Court because this is one of the very few plants in the world that actually reduces pollution in India and not increases pollution in India. So we think we can approach with the proper justification. And hopefully, we are hoping that we should get some, better, favorable response, and probably, hopefully, in the next 2 months, 2 to 3 months, maybe. And once we have that, we can start the plant. And it, as Jerry mentioned, it may take about to start a rotary kiln calciner, say Robinson, it may take about 3 to 4 weeks, and to start a shaft calciner, it will take about 6 to 8 weeks.
Okay. Great. And another question was on if you could give a bit of understanding on what the current dynamics are with related to metals. It looks like the metal companies are making greater margins. We being a converter on the dynamics of both our distillation and calcining business, On the distillation side, what I understand is that the steel upcycle, makes the availability of coal tar more easier for us, and that reduces our cost in that business. And basically, the aluminum upcycle gives us the opportunity to price our products of pitch higher, because in that segment at least there are very few plants now which are working around the world except China. So in that business, if that can increase our margins going forward, the converter margins, and on the calcining side, how are the dynamics given both GPC and CTC are in a rising maybe environment, maybe a dollar margin might be going up, but the percentage might remain the same. Is that correct?
Yeah, as far as the distillation margins, be it coal tar pitch or the related derivatives that we get off of the related products that we get off of the coal tar that we distill. Dealing with, I want to be very careful in a world where we have not seen full recovery from COVID yet in projecting too much. But your basic philosophy that you've expressed would be correct. So if we deal with the scenario of an improving commodity price for the sake of aluminum and oil price, those are favorable conditions for us from a margin perspective going forward. But we always have to balance, supply and demand. How the steel industry goes and demand for steel products affects our raw material supply as well. So we're always playing that spread between our cost for raw material and our finished sales price. But the momentum that's building up in a world where vaccines are being rolled out worldwide, and we're seeing industries return to, from a pricing and from a volume demand perspective, to pre-COVID type conditions, is absolutely bullish, and we are cautiously optimistic about what that can do for us in 2021.
Thank you. The next question is from the line of HR Gala from Finvest Advisors. Please go ahead.
Yeah, congratulations to the team for really good operational results. Although, the selling prices and costs are not in our hands. My question is, looking from the medium-term perspective, how do you see next 4 to 5 years shaping for us? That is my first question for 3 businesses. And what will be our capital investment plans matching with that objective?
Well, we have spent over the last several years, we have essentially made the investments to carry the company for the next 4 or 5 years. So your question is very timely. While we are still getting the investments over the last several years up and running, we anticipate ramping those investments up over the next 2 years. And essentially getting them fully operational and producing at full rates, which will give us the capacity to carry the company over the next 4 to 5 years. And we're also focused on doing this in the most environmentally friendly and sustainable format, because that's really the marketplace that we're facing now as a company. Is we're not just extending, as you heard Jagan say earlier, we're not just essentially adding capacities in new projects, but we're doing it with an extreme attention to environmental responsibility. And that'll be our focus on the next 4 to 5 years as a company, is really taking advantage of the opportunity in front of us to produce clean, green, environmentally friendly products for the 21st century.
Hello.
Go ahead, please.
Hello. My second question will be, what kind of capital expenditure we will be requiring every year to sustain the type of growth which we are expecting?
Our normal capex is going to be about $65 to $70 million. And our capital expenditure may be, basically maybe for all this, we are talking about maybe $10 to $15 million on an average, because we are not planning to make any big investments, at least for the next 3 to 5 years.
Thank you. The next question is from the line of Rohit Poti from Marshmallow Capital. Please go ahead.
Thank you for the opportunity and congratulations on exceptional safety performance in such difficult times. So my first question is on CTP business. We've seen the volumes come down steadily. I was just curious to know how do you see that going forward, and if you think the graphite electrode rebound that is happening right now can help us going forward?
Yes, actually, as a matter of fact, we expect strong demand for all our CDAM products going forward. And as a matter of fact, we are seeing that actually, be it our advanced materials or in the coal and derivatives. We are actually seeing very strong demand for all our products. So we only expect, and the prices in China also having substantially, that will have a good bearing on the rest of the world also. So we do expect strong demand going forward. At least in the near future, what we can see.
Understood. So that was helpful. So next question is on the strategic non-recurring expense of 55 crore that we have. Over the last few quarters, this particular line item is it's been actually quite recurring. So what is this about, and when can we see this particular line item not affecting us anymore?
This is basically the expenditure incurred for the new expansion projects, sir. While the cost incurred for creating an asset will be capitalized, but if any other expenses like operating staff recruited to run the plant or the training of such expenses, those things will not be capitalized, and it will be taken to the regular expenses like operating expenses. So we are adjusting them. Once these capex projects are completed, it can be.
And one more thing is the hurricane expenses, basically, because until such time we get the insurance, we cannot account for it. So we are actually, basically, expensing all the damage that caused due to the hurricane. And once we get the insurance, then basically we will actually add back to the overall revenue stream.
Thank you. The next question is from the line of Pratiksha Daftari from Equitas Investment Consultants. Please go ahead.
Thank you for the opportunity. So my first question is on the CPC prices. I think for last few quarters we were seeing a declining trend, and then a couple of quarters it remained flat. We are now seeing an upward trend, and the presentation says that the realizations have reached $385. I just wanted to understand that what kind of trajectory do we expect given the the demand situation we have right now, and also what kind of spreads do we see given that raw material prices are also increasing?
Yeah, on GPC, you're correct. The GPC price trend had been down. That was more reflective of demand. But as we've seen essentially less raw material available, that trend has reversed itself, and that's bolstered essentially the price recovery that you've seen in the marketplace. That's going to continue as long as global refiners are in their reduced run rate due to COVID. That's mainly due to the global lack of demand for transportation fuels due to the interruption that's taken place. So most of that price increase that you're seeing is related to again the shortage of raw materials and rising prices for raw materials driving the finished product price. And the second part of your question I didn't get. If you can repeat it, please.
I was talking about the increase in price that we are seeing in CPC and the spreads. What kind of spreads do we see between GPC and CPC going ahead? Do we see the spreads expanding?
The spread right now has basically been maintained. So that's indicative of our cost moving with the revenue side, and that's really projected throughout this year. With the 4.7 million tons of additional demand coming on globally, that could the expansion potential there for margin is there in the remainder of this year as that new capacity comes online, aluminum capacity, because the demand can be driven. But it'll be the demand side that would allow us to expand our margin going forward. But I do see that as a better propensity than any squeeze on our margin through this year.
Okay. And my next question is about the Robinson plant. What kind of volumes have we been doing from that plant in last few quarters?
Yeah, we've roughly been doing about over the last several years about 150,000 tons a year from the Robinson plant. We have not been producing at full capacity, but that's roughly the volume that's been taken off.
Thank you. The next question is from Vikram Sharma from Meraki Wealth Management. Please go ahead.
Yeah. Hello, sir. Sir, we are facing many problems in ongoing capex. What total amount of cost increase in our ongoing capex due to delay in project? And also, sir, many things are on track now. Then what problem we are facing related to limited construction workforce availability?
See, basically, I would say that we are actually experiencing project cost increases of over 10 to 15% because of the delays. Workforce means, because of COVID, basically, say in India, the workforce has come down. Pre-COVID now, the workforce is about 60% than what was needed. But we took a little extra, but we did complete the plant. Now there are final stage of completion. Similarly, in HSCR plant is more or less complete, and actually we are starting construction. The production has commenced. And now that we don't have any major investments, this should not impact us anymore.
Okay. And sir, another in HSCR we have mentioned about in our investor presentation, operation team continuing to manage issues. So what is issue exactly?
Basically, we are trying to see. Normally, most of the HSCR projects use a particular raw material, but we are actually trying to use materials that we have. And so we are actually having a little more issues trying to use these new types of raw materials. And it's taking a little longer to stabilize. But the advantage of using this will be we will be able to reduce the raw material costs substantially. So hopefully, but I think we are on the right trajectory. We are actually able to, we are actually slowly getting there, and our products are actually being approved by a few of the customers. We are actually getting the required qualities. So, but to stabilize a plant, and especially a HSCR plant, is a very, very complicated plant. One of the most recently built plant, very few of the recently built plants. So it's taking a little extra time, but I am very sure that our team will be able to get there soon.
Thank you. The next question is from the line of Gunjan Kabra, who's an individual investor. Please go ahead.
Sir, I wanted to ask, in the conference call of Alcoa, they guided that they project CPP price to increase in the first half of 2021. And also in the Copper's on call, they highlighted that the availability of coal tar next year will increase in the US, and they will not have to import from Europe and other countries, thereby reducing their costs. So where do we see the prices and the availability cost of coal tar going forward for rail industries? So can we expect a better margin in this division going forward?
Gunjan, are you referring to Availability of coal tar in North America. What is it you're referring?
Sir, in the conference call of Alcoa,
Okay.
they guided that, they expect the CPP price in the first half of 2021 to increase. And also Copper said that the availability of coal tar in the US will increase. So do we see the price and the availability or the cost of coal tar going forward for rain? Like, what do you see on them? Can we expect a better margin from next 2-3 quarters?
Basically, Gunjan, both in the CPC business and CTP business, the pattern of changes between raw material and finished products will be the same. If continuously the raw material prices are increasing, in line with the prices of raw materials, even the finished product prices will be increasing. Mr. Jerry also explained in the beginning that there is so much of aluminum production is taking place in China and rest of the world. There is more demand for the product, and China exports are also declining. That is definitely will result in increase in the prices of both CPC and CTP.
Yeah, to add to what Srinivas just said, earlier I was talking about the supply-demand economics on calcination. So you're asking more from the distillation side. While the steel industry is essentially still depressed due to COVID and demand factors, we're comfortable with the opportunity that we have this year from the distillation side. We don't see the gating issue as much from demand because of the lesser amount of players from the distillation side that are in the coal tar pitch markets. So overall, we do see, we are cautiously optimistic about the opportunity that 2021 and continually increasing demand will provide for the distillation business.
Thank you. The next question is from the line of Saket Kapoor from Kapoor and Company. Please go ahead.
Yeah, Dhanyavad sir for the opportunity. Sir, firstly, if you could give the average utilization levels, sir, how have they planned out over the last 6 months? And what was the average for the entire last year for December 19 across the verticals?
Yeah, I would say that both 2019 and except barring India, where we had shut down the plants for about 4 to 5 weeks. I think it is flat actually, the capacity utilization in 2019 and 2020. But just to give you an idea, carbon sector is at about 80% capacity, and advanced materials last year has at 65% capacity utilization. But you will see improvement in 2021 because advanced material, because we have only one plant now, and basically the demand is actually picked up quite a bit. So you will see a much higher capacity utilization, closer to almost 90% plus. And carbon also, whatever except the plants that are not operating due to various reasons, be it the Robinson and the India SEZ plant, we expect the average capacity to be above 90% this year.
But with the sale of the units, sir, how much will there will be decline in the revenue? The existing one will be ramping up from 60 to 90. So what will be the decline in the revenue in absolute terms, sir?
The revenue, that was contributing about $80 million of revenue.
Right, sir. So we also see this depreciation part also being higher. So what is our current capital work in progress, sir? And what are the new projects that are planned to be capitalized in the near future?
Actually, in 2020, the depreciation is higher for 2 reasons. Reason one is we have capitalized HHCR plant in June 2020 quarter, and so we started providing depreciation on that. Though the trial productions are going on and revenues are not generated, we are depreciating because the plant is ready and construction is completed. Apart from that, we also have implemented the new lease standard where assets taken on operational lease also is expected to be capitalized. That has resulted in about on a quarter about $3 to $3.5 million of additional depreciation is getting provided. But that is only reclassification of operating expenses, lease rentals into partly as depreciation and partly as interest. And the three projects under construction are like the ACP projects in India and US. Once they are completed, we will be capitalizing. And the vertical shaft plant also will be what we are constructing in SEZ in Visakhapatnam, India. That also gets capitalized once the construction is completed mid of 2021.
Thank you. The next question is from the line of Tirath Machala from Elucividia Advisory. Please go ahead.
Hi, sir. Thanks for taking my question. I wanted to know that, about a year ago when we broke out the advanced materials segment, there was a focused thrust on catering to battery technologies or energy storage technologies, and there were a few senior recruitments that we had done. So my question is that, are you seeing increased demand from those industries, be it lithium-ion or any other kind of energy storage industries?
Quite a bit. As a matter of fact, we are actually seeing quite a bit of demand from the battery industry. But to an extent, we are not able to service that much quantity, and we are actually trying to figure out, can we do a small capex or something like that so that we can actually get there to be able to meet this demand. Yes, basically whatever we said last year of the increased demand, we are seeing that, and it is actually growing quite a bit. So, and our team actually is doing a good job actually trying to make the products required.
So any kind of expansion in that segment, would it be R&D related, or would we need to acquire some expertise, or how would it work? Or is it not a material contributor to our company even going forward?
No, actually it will be our own proprietary technologies. We don't need to acquire it from anywhere outside. It will be based on our own R&D. And it is actually a product that we do make, but the demand is for much larger quantities. So.
Thank you. The next question is from the line of Bhavesh Patel from Patel Investments. Please go ahead.
Hi. First of all, congratulations on relatively good numbers with a COVID backdrop, and also thinking strategic for years ahead. My question is, when do we expect our Germany plant, which produces the water-white resins, to get close to 100% utilization? And I know this is forward-looking, but just to get an idea, because we have signed up and seen some success with initial customers. And also important because this is our highest margin product comparatively.
See, basically, we hope to be able to, the plant should reach the capability to produce at a higher capacity probably in the next 2 to 3 quarters. But we also have to, our product has to be tested by various customers, and it has to be accepted. So the trajectory may be a little bit higher. So this year, for 2021, we are targeting a capacity utilization of about 70%. And probably in an increased ramp up in the next 1 year or so thereafter.
Fantastic. That sounds pretty good. And the next question is in terms of next 4 to 5 years. And again, you have listed out your priority to reduce debt. Do we consider this to for us to be able to achieve close to, let's say, even 15 to 20% of the current debt that we have on the books? That sets up for a very, very strong future ahead with much lesser drag on from the debt that we have, which is close to $1 billion.
See, actually, if you look at our debt, we have $1 billion, but our net debt now, I think, in December 2020, it's only about $800 million plus. So our target is to reduce in the next few years. Because as we said, we don't have any major capex. Like Jerry was mentioning earlier, the last several years, I would say almost 7-8 years, and we've been continuously investing on capex, and we want to bring down that, and so we should have improved cash flow both from our normal cash flow as well as these new projects that are actually going to, basically also should throw up some cash. So based on that, we do expect to reduce our debt, and I cannot comment on how much exactly we can pay, but we do expect that it should come down. Our target debt to EBITDA ratio should be well below 2.5 is our target to be as soon as possible. And also we want to bring down our average interest rate to about 4%, which we are hopeful that we can do it in the next 1.5 years.
Thank you. The next question is from the line of Akhilesh Kumar, who's an individual investor. Please go ahead.
Hi, thanks for taking my call. Just in the call, I have heard Jagan and Sweeney mentioning that our vertical shaft plant is complete and we are just waiting for the government permission for importing the GPC. So if I take on that, your estimate of say 1-2 months to get the government permission and then an additional 1-2 months for plant to restart, effectively we are hoping for not before Q3 to start, right?
Q3 may be a possibility.
Okay, and that also only if we don't end up going to Supreme Court, right?
See, this time, we have asked for permission from the government, and without getting the government permission, we should not be questioning basically going and saying that we'll approach Supreme Court. We are hoping that government will take a favorable decision soon.
Yeah. And I have one more thing, just wanted to check on that. Like our Indian smelters, are they not still facing any issue, constraint because of these import quotas of CPC? Or like say they are not approaching government or Supreme Court?
No, they are actually, we actually, our thought process, and in case next time we want to request the aluminum smelters also join in if you have to approach the Honorable Supreme Court. Because, it's impacting all of us, especially now with how you have read from the various press statements that NALCO is talking about increasing capacity, Vedanta is expanding. So if everyone needs material and India is talking about Atmanirbhar Bharat, if you want to maintain all of this, India production has to increase. And one good thing, as we said earlier, this process actually reduces pollution in India, doesn't increase. With all these benefits, we see the government actually taking a favorable decision. So,
thank you very much. We'll take that as the last question. I would now like to hand the conference over to Mr. Jagan Reddy for closing comments.
Thank you. 2 months into the first quarter, there is ample reason to be cautiously optimistic about 2021. With the recent introduction of COVID vaccines around the world and a steady decline in the number of positive cases, demand for many of our products is nearing a return to pre-pandemic levels. The surge in aluminum demand and LME prices is also very positive and a sign that we could be entering into a commodity super cycle with a multi-year growth trajectory. In the months ahead, top priorities will be to further ramp up sales and production of our advanced resins and to commission the shaft calciner and ACP production facilities. Beyond that, we know that we must continue to aggressively manage costs, including a reduction in capex spending as our major projects are completed. At the same time, generating new and reliable cash flows will allow us to reduce the company's debt profile. Finally, we must continue our metamorphosis into a 21st century company that transforms industrial byproducts into essential materials for lighter, cleaner, and faster products and applications that have the dual benefit of creating new market opportunities for our company and driving long-term value. In a society where sustainability is quickly becoming a license to do business, our ability to maximize the productivity of carbon by upcycling these byproducts makes rain an indispensable player in an increasingly sustainable society. Thank you all for joining us today. Best wishes in the months ahead. Stay healthy and safe, and we will speak with you again in the next quarter. Thank you very much.
Thank you very much. On behalf of Rain Industries Limited, that concludes this conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.
Playback is complete.